Imagine you are in year 1999. You meet an investor who tells you that within the next 20 years, people would buy products online, watch movies online, communicate through social media, store data in cloud, and carry internet in their pockets. It would sound unbelievable, isn't it? Now imagine that same investor also tells you that the internet stocks are about to lose 80-90% of their value over the next couple of years. Would you believe that? The surprising part is that both predictions turned out to be true. The internet transformed the world, but many investors still lost massive amount of money during the dot-com crash. And internet is not the only example. Throughout history, new technologies have repeatedly created periods of extreme excitement. Railways, electricity, automobile, telecom network, and now internet all triggered massive investment boom. In many cases, the technology eventually succeeded, society benefited, businesses changed forever, but shareholders often suffered because expectation became too optimistic and capital flooded into the sector far faster than the eventual profits justified. There's a fascinating book called Engines That Move the Markets that studies more than 2 centuries of technological revolution. It says technologies change, but human behavior does not. Investors repeatedly make the same mistake. They overestimate short-term growth, underestimate competition, and confuse a great invention with a great investment. And today, there is one technology that is dominating global market in exactly the same way: artificial intelligence. Just to put the scale into perspective, the 4 largest hyperscalers in the world, Google, Amazon, Microsoft, and Meta, are expected to spend nearly $600 billion on AI-related capital expenditure in 2026 alone. At the same time, Gartner estimates that worldwide AI spending could reach approximately $2.6 trillion in 2026. And that is only the beginning. According to McKinsey, cumulative global investment in data centers infrastructure could approx $7 trillion by 2030. In other words, companies are not just spending money on AI software, they are simultaneously building the physical infrastructure like data center, chips, power system, networks that is required to support the AI economy. Now let me be very clear, there is no denying that AI could become one of the most transformative technologies in our lifetime. The question is not whether AI will change the world. The question is whether investors and corporations are becoming too optimistic about how quickly AI can generate economic value. Because history teaches us a very important lesson. Sometimes the technology is real, the adoption is real, the impact is real, yet investors still lose money. And that usually happens when people stop distinguishing between a great technology and a great investment. This is exactly why investors today are making comparison between AI boom and internet boom of late 1990s. Back then, investors correctly predicted that internet usage would explode and internet traffic did grow exponentially. But telecom companies and network operators started building infrastructure at an even faster pace. Billions of dollars were invested in laying fiber optic cables across countries and oceans. The problem was not weak demand. The problem was excess supply. Capacity expanded much faster than actual usage. Eventually, prices collapsed, returns collapsed, and many infrastructure companies destroyed shareholder wealth despite being right about the long-term future of internet. Fast forward today, every major technology company is racing to build AI capabilities. Every venture capitalist wants exposure in AI. Institutional investors are chasing AI, retail investors are chasing AI, and technology companies are investing hundreds of billions of dollars into chips, data center, LLM model, and infrastructure. This is where the debate around an AI bubble begins. Are we witnessing the early stage of a technology revolution that will justify these investments? Or are we witnessing another period where expectation and capital spending have moved far ahead of economic reality? This is exactly what we will discuss in this video. First, we'll look at the arguments supporting the AI boom and why many experts believe that current AI investments are completely justified. Then we'll examine the opposing view, the argument that AI may already be entering bubble territory. And finally, we'll discuss what happens if AI is really a bubble in making. Because when the dot-com bubble burst, Nasdaq tanked nearly 80% and its impact felt across global market, including India. I sincerely hope we never see a repeat of that situation. But if there are meaningful similarity between today's AI boom and previous technology bubbles, then understanding the risk becomes just as important as understanding the opportunity. So let's get started. So the first argument that supports the fact that this AI boom is not like dot-com era is that back then many internet companies had no profit, no sustainable business model, and in some cases barely any revenue. Investors were simply buying dreams. Today, companies leading the AI race like Microsoft, Google, Amazon, Meta, Nvidia are some of the most profitable businesses in human history. They are not raising money to survive. They are using their own cash flow to fund AI investment. The second bullish argument is that the opportunity itself is enormous. AI could potentially impact healthcare, banking, manufacturing, education, logistics, legal services, and almost every knowledge-based industry. In other words, AI is being viewed as a general purpose technology similar to electricity or internet. If that turns out to be true, then today's spending may look expensive but not irrational. Then third argument is perhaps the most important one. The biggest technology companies are not slowing down. In fact, they are accelerating their investments. Every major hyperscaler is increasing AI spending because nobody wants to be left behind. In fact, Sundar Pichai recently admitted that even Google is struggling to keep up with the demand for AI products and services. And that's a very important point. Most CEOs are not saying demand is weak. They are saying demand is stronger than expected. Then fourth argument is that the structure of this AI boom is very different from 1999. The dot-com boom was largely driven by retail investors chasing anything with a dot-com attached to its name. Today's AI boom is being driven primarily by institution, pension fund, sovereign wealth fund, and large asset manager. That does not mean prices cannot fall. They absolutely can. But it makes the price action less panicky than 1999. And finally, there's a very interesting argument around power and infrastructure. Today, one of the biggest bottlenecks in AI is not demand. It is electricity and data center capacity. Building large AI infrastructure takes years. Power approval takes years, data center takes years. As a result, existing infrastructure has become extremely valuable. Some analysts actually argue that this scarcity could protect the profitability of current AI infrastructure providers because new supply cannot be created overnight. Now let's look at the other side of the argument. So the first concern is that AI investments are growing much faster than AI revenue. Today, companies are spending hundreds of billions of dollars building data center, buying GPUs, and securing power infrastructure. The question is simple. Will these investments generate enough revenue to justify the spending? Some analysts believe the gap is becoming too large. This is very similar to what happened during the internet boom. Investors were right about internet adoption, but they underestimated how long it would take for those investments to become profitable. Then second concern is on valuation. There are a few indicators that investors use to judge whether the overall market has become expensive or not. One of them is Shiller cap ratio. So instead of looking at 1 year's earning, it compares stock prices with inflation adjusted average earning over the last 10 years. Historically, the US market has traded around 17 to 20 times on this metric. During the dot-com peak in 2000, the ratio crossed 44 times. And recently it crossed 40 times again. Not exactly at dot-com level, but close enough to make people nervous. Another popular indicator is market cap to GDP ratio, often called the Buffett indicator. The logic is simple. If stock prices keep rising much faster than the economy itself, eventually valuation becomes difficult to justify. During the dot-com bubble, the total US stock market was roughly around 140% of US GDP. Today that number is around 230%. In other words, the stock market has become significantly larger relative to the size of the economy than it was even during the internet mania. This does not automatically mean the crash is coming. Market can remain expensive for years, but it does suggest that investors are already pricing in a lot of future success. And perhaps the most interesting signal comes from Warren Buffett himself. While everyone is talking about AI and chasing growth stocks, Berkshire Hathaway has quietly accumulated one of the largest cash positions in history. Berkshire is sitting on hundreds of billions of dollars of cash and treasury bill. Now, Warren Buffett has not explicitly said that AI is a bubble. But historically, whenever he struggled to find attractive opportunities, he preferred holding cash rather than overpaying for asset. Think about what that means. One of the greatest investors of all time is effectively saying, I would rather earn 4-5% in treasury bill than buy many stocks at current valuation. Again, it does not prove that AI is a bubble. Buffett has been cautious before and markets have continued to rise. But when valuation reach levels that even disciplined long-term investors struggle to justify, it is worth paying attention. Then third concern is market concentration. In fact, this may be one area where today's market is even more extreme than 2000. The Magnificent Seven compose more than one-third of S&P 500 total market cap. This concentration creates fragility. When Cisco tanked in 2000, it sank every broker's portfolio. Today, any significant correction in Nvidia or Google would ripple through virtually every passive investment vehicle on this planet. Also, if you observe, Nasdaq continues to make new highs. But the rally has been heavily concentrated in a few AI giants. Otherwise, the overall market breadth in S&P 500 is quite weak. Then fourth concern is debt. During dot-com era, most speculation was funded through equity. Today, a growing portion of AI infrastructure is being financed through debt market. If AI investment fail to generate expected return, the risk could extend beyond shareholders and into the broader credit system. And finally, there is the adoption lag problem. Almost everyone agrees that AI will eventually transform industries. The debate is about timing. Investors are valuing companies based on the assumption that AI monetization will happen quickly. But history suggests that technological revolutions often take much longer to generate profits than market expect. The internet changed the world, yet many internet investors still lost money because commercial adoption took longer than anticipated. And today, AI could follow a similar path. And this is where the comparison with dot-com era becomes fascinating. There are clear differences. Today's leaders are profitable, revenues are real, technology is working, but there are also some uncomfortable similarity. Valuations are elevated, capital market is exploding, market concentration is near historic high. And once again, investors are betting that a revolutionary technology will transform the global economy. This takes us to the final part of the video. What can we expect from an investment point of view? Let's discuss it. So after looking at both sides of the argument, the obvious question is, what happens next? The truth is, nobody knows with 100% certainty. In fact, one of the biggest mistakes investors make during bubble is assuming that because something looks expensive today, it must fall tomorrow. History does not work like that. Nasdaq looked expensive in 1997. It looked even more expensive in 1998. It looked absolutely absurd in terms of valuation in 1999. Yet it kept going higher before starting collapsing in March 2000. Investors who correctly identified the bubble but exited too early missed one of the biggest rally in market history. The same thing can happen with AI. Even if somebody believes AI valuations are stressed, that does not automatically mean a correction is around the corner. The reality is that AI spending is still accelerating. Hyperscalers are still increasing capex. Demand for GPUs continues to exceed supply. Enterprise adoption is still in its early stages. And unlike the dot-com era, the biggest beneficiary today are reporting massive profit and cash flow. This is why timing bubble is extremely difficult. Identifying excess optimism is much easier than predicting when that optimism will end. For instance, Berkshire Hathaway has been sitting on massive cash for a long time now. And since it does not participate in AI rally, it has been underperforming the market for a long time now. Personally, I think the key variable to watch is not stock price movement, but economics. The moment investors start seeing signs that capex is rising much faster than actual monetization, sentiment can change very quickly. So the range of outcome is actually quite wide. AI stocks jump 30 to 50% higher a year from now and still end up being part of a bubble. Both things can be true simultaneously. That's exactly what makes this phase so fascinating and yet so dangerous for investor. Now, if I were to think about the next few years, there are broadly three possible outcomes. The first scenario is the bullish outcome. AI revenue continue growing rapidly, enterprise figure out how to monetize AI faster than expected, and productivity gains start showing up across industry. And the massive capex being deployed today eventually gets justified. In this scenario, markets may witness normal correction of 10-20%, but broader AI upcycle remains intact. Nvidia, Microsoft, Alphabet, and other leaders continue growing into their valuation. Then second scenario, which is probably the most realistic one, is that AI succeed but expectation cool down. If revenue growth takes longer than expected, if hyperscalers struggle to earn adequate return on their investment, or if investors simply decide that current valuations are too expensive, then a 25 to 40% correction in AI-related stocks become entirely possible. Personally, this is the scenario I find most plausible. Then third scenario is the extreme outcome, something similar to dot-com bust. This would require multiple things to go wrong simultaneously. AI adoption disappoints, economic growth weakens, capex slows dramatically, and investors start questioning the economics of entire AI ecosystem. In that situation, AI-related stocks could potentially witness drawdown of 50-60% or even more. Now, before you panic, I want to make one thing clear. I think the probability of a 70-80% Nasdaq collapse similar to 2000 is significantly lower today than it was during the dot-com era, because the companies leading the cycle are fundamentally different. Back then, many companies had no profit, no cash flow, and in some cases, no real business model. Today, Nvidia generates tens of billions of dollars in profit. Microsoft generates tens of billions of dollars in free cash flow. Alphabet, Meta, Amazon are extraordinary profitable business. So even if valuation compress, the underlying business remains strong. That is why I think a 20-40% correction is far more realistic than a repeat of dot-com crash. But now, let's bring the discussion back to India. If the US market corrects because of an AI reset, India will not be immune. In the short term, India will almost certainly feel the pain. Foreign investors could reduce risk across emerging markets. Technology stocks may correct, market sentiment could weaken, and sectors linked to AI infrastructure build-out, including data center theme and AI-related capex beneficiary, could face a massive correction. But here is where the Indian story becomes interesting. Unlike the US, Taiwan, or South Korea, India is not at the center of this AI trade. Taiwan's market is heavily dependent on semiconductor manufacturing. South Korea is deeply exposed to memory chips and electronics. India is different. In fact, India has been one of the biggest laggard in this AI race. And that could actually become a strength if AI trade starts unwinding. Because if global investors begin rotating away from AI-heavy market, they will eventually look for economies with stronger domestic growth driver. And India fits that description quite well. At the end of the day, India's growth story is still driven by consumption, banking, housing, infrastructure, manufacturing, and financial services. AI may influence these sectors, but it's not the primary engine behind them. This is why I believe India could initially fall along with the rest of the world, but potentially recover faster than many AI-heavy markets. This is also another interesting angle. Today, one of the biggest fears surrounding Indian IT sector is that AI will eliminate software jobs and permanently weaken the outsourcing model. But what if AI deployment turns out to be slower, more expensive, and more complicated than market currently expect? Then many of the disruption fears built into Indian IT valuation may start fading. Global enterprises would still need cloud migration, cybersecurity, data engineering, AI integration, governance, and workflow redesign. And if AI becomes an implementation challenge rather than simply a coding challenge, Indian IT companies could actually become beneficiaries. And if that happens, India may actually emerge as one of the most resilient markets globally. I've recently done a video on whether IT is a good counterbet or not. So overall, a sensible approach in this current environment is to remain diversified across equities, gold, and fixed income instruments. Equities remain the best asset class for long-term wealth creation, and completely avoiding them because of bubble fear can lead to significant opportunity loss. At the same time, keeping a reasonable allocation to debt or fixed income instrument provides the stability and, more importantly, liquidity. If market witness a meaningful correction, investors with some cash or fixed income allocation will have the ability to deploy cash at much more attractive valuation. Gold also deserves a place in the portfolio because it acts as a hedge during period of geopolitical uncertainty, currency weakness, inflation concern, and financial stress. Ultimately, investing is not about predicting a single future. It is about preparing for multiple futures. Maybe AI continues driving markets higher. Maybe there's a 30-40% correction. Maybe geopolitical risk intensify. Nobody knows. A diversified portfolio may not be the most exciting strategy during bull market, but it is often the most effective strategy for navigating periods of uncertainty. Because in investing, staying in the game is usually far more important than trying to predict perfectly what happens next. So that's it from my side in this video. Now I would love to know your take on AI. Is it a bubble or not? And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.